Hello, welcome to this week's Private Funds Update. I'm Sandra from SmartEsq, and today is Thursday, April 16th, 2026. We've got a lot to tell you today. A historic Form PF rollback, expedited tender offers, a major DeFi lifeline from the SEC, and the UK's new crypto perimeter. Let's dive into the details. First up, a massive compliance reversal. The SEC and CFTC have jointly proposed amendments to significantly roll back Form PF reporting requirements for private fund advisors. Here is what is on the table. The proposal seeks to undo the heavy-handed data grabs passed in recent years, eliminating several granular, event-driven reporting triggers, and reducing the overall data burden for large hedge funds and private equity advisors. The public comment period will be open for 60 days following publication in the Federal Register. The agency's leadership did not mince words. Commissioner Hester Peirce playfully titled her statement, "PF stands for Please Fix," arguing the rollback corrects a regime that treated private funds like highly regulated public utility companies. Commissioner Uyeda echoed this, noting the proposal finally right-sizes systemic risk monitoring without drowning GPs in unnecessary paperwork. However, the reaction from industry practitioners is mixed. Leading fund formation and compliance attorneys are calling this a welcome, albeit chaotic, relief. Practitioners observe that while reducing the reporting burden saves immense capital in the long run, it is causing acute operational whiplash. Many GPs just spent millions of dollars building automated data pipelines to comply with the previous administration's expansive rules, only to have the regulatory goalposts moved back. Next, a major accelerant for liquidity events. The SEC has issued a landmark exemptive order that cuts the minimum tender offer period exactly in half. For certain fixed cash tender offers for equity securities, the mandatory window drops from 20 business days down to just 10. For private equity sponsors executing specific public-to-private buyouts or structuring specialized liquidity programs, this shaves 2 full weeks off deal timelines, significantly reducing market exposure and deal completion risk. Pivoting to Web3, the SEC staff issued a game-changing statement for decentralized finance. They have effectively cleared a path for decentralized crypto asset trading by issuing guidance that developers who merely provide user interfaces or front-end website-style smart contracts will not be forced to register as traditional broker-dealers. This is a massive lifeline for DeFi developers who feared that building a simple web portal to a protocol would trigger crushing federal broker compliance. Finally, looking across the pond, the UK's Financial Conduct Authority is officially consulting on perimeter guidance for its future crypto regime. The FCA is drawing hard lines to define exactly which crypto assets fall inside the regulatory net and which sit outside. For global funds trading digital assets, the UK is rapidly clarifying its rulebook, moving to make London a highly predictable and attractive hub for crypto capital formation. That's your briefing for today. As the SEC reverses course and global rules shift, managing regulatory whiplash manually is a losing battle. You can learn more about how the SmartEsq platform can help you. If you are curious about the services we offer, please visit www.smartesq.ai.